Well, something big is brewing, and it might be taking place in the very near future. On today's video, we're going to be looking at some charts that make you go, interesting. We're also going to dive into some of the intermarket stuff that is taking place in markets. Going to look at the conditions of the market and the expected moves going into the next trading week. We're going to kick it off with the market snapshot, how the markets responded to this jobs report, all that and more on today's stock market brief episode, which, by the way, is powered by you. So go ahead and sponsor today's episode by hitting that thumbs up. It's greatly appreciated. And subscribe to the channel if you like this type of content. If you want more in-depth stuff, make sure to check out the link that is in the pinned comment and in the description, where you can get access to my Trade Ideas channel on Patreon, which gives access into my Discord, where I post all of these benefits here. It's $16 a month. You can save if you buy it annually. It's not an alert service, but I do give some ideas. I give my updated watch list and tight list every week, so you'll be having that before Monday. I give expected moves, and I also have my Asher bot that I just recently added more to, that if you just type in the command, you'll get weekly ranges for risk, you'll get daily ranges, and now you will have monthly. Plus, you can look at historic ranges, and then you could also look at eyeball premiums and discounts all within that. Not only that, you get the entire TradyTix auto posting bots and the query channel, which allows you to type in all types of commands to get various data points around gamma exposure, IV, net flow, all types of cool stuff, and that's all included in that $16 a month. So if you want to check it out, make sure to do so. Let's hop into today's show. All right, ladies and gentlemen, welcome back to the show. We're going to start off here looking at the market snapshots. We did get that jobs data in, and the market looked really nice on the response. But then all of a sudden, we started selling off. We bounced up a little bit, and basically we closed once again unchanged on the week. If you look at the SPY over here, week-to-date performance, 0.34%. So we did finish up 30 basis points, but that's rather flat. The Qs finished up a little bit better, and IWM was the outperformer there, 1.1% on the overall week. If you look at this from an intramarket standpoint, towards the bottom of the list, what do you got? Yields, right? Yields is closely tied to oil, and then you also have the dollar down here too. And when we know that when the dollar and the yields go down, it's quite beneficial for markets. At least that's what the correlation currently stands right now, given the current context of the rate of change. That may change in the near future. Now, overall, the 11 sectors that make up the S&P 500, we had communication services lead the way and discretionary. No surprise there. We saw big move from Tesla. We saw a big move from Apple in sympathy to Google, and we saw those being the outperforming sectors overall. Technology finished rather flat. And then towards the bottom of the list, we had financials, which took a bigger hit today. Energy as well, which is a more bullish sign for the markets when S&P 500 outperforms that, and then utilities down there as well. If you take a look at the S&P 500 from a weekly perspective, every candle represents one trading week. And well, for the last 4 weeks, we've basically closed unchanged, right? We close here, we're up a little bit, we're down a little bit, we're up a little bit. Very, very, very tight closing range. When you're looking at this, you're going from like 481 to 450. We're talking within the weekly closes within a 30-point range, which is incredibly tiny for the S&P 500. And then for the last 5 trading weeks, we've been in a tight range too. 6,500 down to and around 6,350, which is about a 150-point range. Remember, markets move between periods of contraction and expansion. Right now, we are in a contractionary consolidation so far in the S&P 500. So when the move comes, when a move happens, it could be rather explosive. S&P 500 on the daily chart over here, you can see from the daily perspective, we've been just chopping around. No surprises there. Once you start to see some of the other charts and market conditions, you can see the bearish divergence that's still forming here on the RSI, and the percent price oscillator has been just flatlined. There's no momentum here at all, but we did hit a new all-time high today. We closed at a new weekly all-time high, so that's not necessarily bearish, but it doesn't mean that we can't see 5% corrections to 8%, maybe even 10% corrections still within this year. If we continue on and look at this is one of the indicators that I built out using AI. It's looking at rate of change, multiple time frames, momentum, and I know that some people really like this because it called this perfectly, and then also triggered right before December 18th over here, which led to all this selling. And I just want to call out that we did hit a new all-time high. No surprise there, right? We had some bullish momentum to the upside, but it is still red. It takes a while for these things to switch over, so we'll continue to monitor that. Qs still in the red there as well. That was the leading portion of it. And then IWM, it has not flipped. It is still green since down here, and it turned red over there. If we continue on, we're going to look at all the charts here that make you go, the bigger picture kind of stuff. We honed on this in the last couple of videos. And the reason why I want to point this out is because I feel like something big is brewing on the horizon. Now, timing it you can't really time these things for the most part, but you got to just be aware that they're there, because when the conditions of the market actually change, and if it is going to be something big and play out, you really have the opportunity to get ahead of it early and protect yourself, right? It is this portion, I want to be very clear. This is not about being very bearish and shorting the market. That's not what this is about. It's only here to prepare you, because as Hemingway once said, gradually and then all at once, right? How do you go bankrupt? Gradually and then all at once. So risk, it happens slow, and then all of a sudden it can happen incredibly quickly. So this is why I'm kind of displaying this. And these charts, right, there's back and forth on these specific types of charts, right? We don't need to get into the it doesn't matter, it does matter, but it is still interesting because it has some historical proof to it. This right here is a cycle chart, and the cycle, right, the background of this, Samuel Benner was an Ohio farmer, and they lost everything in the 1873 panic, and he studied the commodity and stock price cycles and published this forecast in 1875, I believe. Yeah, 1875 it was. And it's basically mixing 18 to 20 year rhythms for panics and 8 to 10 year rhythms. And you could see there's like periods of A, B, and C, right? And as you can see, A is the years which panics have occurred and will occur again. That was the forecast, right? B is the years that are of good times, high prices, and it's typically the time to sell. And if we just look over here at these bigger moves. Well, look at 1999, right? That was the dot-com bubble. And then over here, which was things were looking good, but it was a time to sell. That was in 2007. So pretty interesting there. And then guess what? 2012 was that bottom. 2019 over here, a good time to sell. We went into the pandemic. Pretty interesting stuff. And then at the bottom over here, 2023 actually was one of the best, like coming out of that 2022 bear market, right? We came out of the 2022 bear market and was a great year to go long. And it has been a good year. And now we're moving into 2026. We're a few months away. And this is typically where we start to reach those cycle tops according to this specific chart. And then, right, we can go potentially down into and around 2032 and all of a sudden see some sort of a bigger bull market there too as well. So the chart here, right, is it going to play out like this? I have no idea, but it is very interesting, right? I would say this is very interesting. I mean, shoot, you can go back to 1927 over here and, right, we went through the Great Depression. Very cool, very interesting. You may have seen this before, but I wanted to share it once again because we are nearing a period in time where we tend to hit these cycle tops. Now let's pair this with some other stuff. Take a look at the Buffett Indicator. I've shown this one multiple times. This Buffett Indicator is taking it's the U.S. stock market value to GDP, right? So you're taking the total U.S. stock market value, which is 65.47 trillion at the end of June, dividing it by the annualized GDP, which is 30.15 trillion. You're getting 217%. So you're seeing it here at these two standard deviation levels. If I was to show you another chart, which you can get a little bit cleaner of a look, right over here as of June 30th, right? We're in September now. It hasn't fully updated yet, but we are at a 2 standard deviation level. The last time we were here was going into what? This is, well, coming out of really the pandemic or right around those times. And what happened over here, we went into the bear market in 2022, but we had also the Fed step in big time to relieve the pain of what happened from the market sell-off during the pandemic, okay? And then prior to that, you had the 2 standard deviation move at the internet bubble, right? The internet bubble was over here in 1999, 2000, and so forth. And also, when we pair it a little bit further, I did find this chart was interesting. I shared it a few days ago. This is the weekly relative strength chart between consumer staples, right? Safety type names, things that people need versus things that people want. And it's relative to the S&P 500, so the SPY chart. And as you can see, this was the all-time low in this relative strength line. And that happened to be right at around that dot-com bubble top. And as the market continues to press higher, we have now just finally reached down to this prior low level, right? We haven't seen this. We went a little bit lower the prior day, but now we are at the worst time in history has consumer staples ever performed versus the S&P 500. And as you can see, when it outperforms by a wide basis, it's typically during periods of panic because people tend to move their money into safer type, lower beta names, things that people need versus things that people actually want. And that's where you could typically see the market kind of fall. Now, I just want to be very clear here. this doesn't mean consumer staples goes up, right? Consumer staples can go down with the market. It just goes down less than the market. That's what could very well be the reason is what we're seeing, because it's a relative strength, not absolute performance. Okay, now this is where it gets interesting, right? We had the jobs data come out. Things are looking weak, and that means that the market is going to start pricing in more rate cuts. Now, that means also why would we cut rates when the market's at all-time high is because the reason why we start cutting rates is technically because things are slowing down, right? The economy is slowing down. So the market here is basically priced in 100% probability of 25 basis point cut, because they're now starting to move it out. They're basically pricing out the ability of staying flat or not cutting rates to zero, because now we have an 8% probability of a 50 basis point cut. So we're getting a 25 basis point cut come September 17th when the meeting is. But now look at what's changed. October, 72% probability of another rate cut. That's a big move. December, 67% probability of another 25 basis point cut. So the market now is pricing in almost definitively 3 rate cuts coming up. So that to me is interesting. Obviously, we still have a lot of data to come out for the remainder of the year. And if this actually holds true, well, that's kind of interesting, because if once again, I want to pull this chart up of looking at the federal funds rate, that blue line, the aqua line is the unemployment rate, right? The last time that Jerome Powell was at the Fed Symposium, he started talking about labor, unemployment, etc., right? We had the jobs data. It's relatively flat over here as far as the unemployment rate goes. But this is where it gets interesting. What do you notice when they start cutting rates? Start cutting rates. And the last 3 recessions happened while we started cutting rates. And what happened in the recession, right? While the rates were cutting, unemployment spiked. Is this time different? I don't know. I couldn't tell you if this time was going to be different, but valuations, right? Looking at the Buffett Indicator, looking at some relative strength stuff that we've, haven't seen for a long time, looking at some cycle charts, looking at what the market's pricing in as far as rate cuts, looking at the history of what's happened during rate cuts and the yield curve, right? The bigger picture charts that we've been sharing, how the market's pressed to new all-time highs. Everything was fine. This time is different. We uninverted, the curve steepened. We went through a 51% crash, right? That was the dot-com bubble. Then the financial crisis. We had the pandemic. Where are we now? Somebody had mentioned the other day in the Discord, well, maybe this was the crash right here. Maybe that was it, the 23%. Maybe so. But I pointed out that, hey, if you look back over to 2000, we actually had a 23% drop right here, and then we went off to all-time highs before we're starting to see this yield curve dramatically steepen here too as well. So what's going to happen? We're going to cut rates. That's what the market's pricing in. This yield curve, it's going to steepen, right? So what's the market going to do? Is it going to prick the air out of this bubble, which by all means, I think that this is a bubble. I don't know the extent of how big bubbles can get, because typically the best thing to do in bubbles is to buy and keep moving and then protect your risk until it pops, because you can make a lot of money in bubbles, that's for sure. Another look here is looking at a yearly chart of the S&P 500. I want to remind people the last 2 years in the S&P 500, we've had plus 20% gains. 2 years back to back, 20% gains. We're up 10% right now on the year-to-date basis. That is rare. So in the last 2 years, if you have been doing incredibly well trading from the long perspective, right? And you're starting to get in your head that like you're some ultimate trader, whatever. I want to be very clear here. The last 2 years, you can basically, in a way, I mean, there's give or take, because there was some internal weakness with all of this stuff, but the last 2 years have been much more simplistic type years to be trading or just invested, because the market's been going on a one-way ticket, including pretty much this year after its little volatility move. So back-to-back years, 23 and 24, 20+%, which is huge. And you go back through history and you're like, when's the last time that happened? Well, it was 97 and 98. In fact, right prior to that was 95, 96. So this bubble went 2020, shot a little bit higher, wasn't 20%. Then we went through a 3-year correction, which, by the way, when's the last time we've seen more than 2 years down in the S&P 500? It was this in 2000. Other than that, you have 1 year down over here, 1 year down, hardly even down, 1 year down, right? And even prior to this bubble over here, right? Even the financial crisis, 1 year down and then we're up, right? And then over here, right? 1 year. You'd have to go back to the 70s for multiple years in a row. It's pretty rare occurrence, which means something very important that might slip a lot of people's minds. When you have years down, right? If you're overly bearish, right? And you're just trying to find a crash, the easy money is made from the long perspective, right? So shorting is very hard. This chart here is proof, right? So you got to be very diligent with risk management. Now, the reason also why I'm bringing this up is because these 2 years, it led to what? A bubble bursting. 1954 and 55. Those were 2 years of back-to-back 20% gains, went a little higher, and then we saw a pretty large correction going into the mid-50s to late 50s. Prior to that, we had 2 back-to-back coming off the Great Depression, and then we saw and that was 35 and 36, in year 37, that was a huge, huge move to the downside in the S&P 500. Prior to that, 27 and 28, then what? We went through the Great Depression, okay? So the reason I'm pointing this out is because these are large, rare moves in short periods of time, and I feel like people are starting to think that this is normal. I want to add another element to all of this is we're trading a lot different in higher volumes, different products, more leverage than we were at any other time throughout history. And there's also a lot of money on the sidelines, including money markets, right? If you look at Warren Buffett, for example, he has his biggest cash pile ever. So another thing that's very important in all of this, and to continue to watch these videos and follow if something cracks, something breaks, is we're going to see much more dramatic moves and faster moves in the market. For example, if we sell off, we can see a very, very fast rip back. And that's what we've been kind of seeing, including this year, right? We saw a big, massive move to the downside. People got incredibly bearish, and we are right there ready, looking for follow-through days in the market to be prepared for larger moves to the upside, which we at that time called the pain trade. Let's continue on and look at some interesting credit and household, look into the consumer, the average person, what's going on. Well, right now, the number of accounts from loan type, I'm just paying attention to this, right? Don't put too much weight on this, but credit cards, right? Continue the amount of credit card accounts are continuing to grow. So more people getting more credit cards, more accounts there. But while this is also occurring, the total balance by delinquency status is starting to kind of uptick here too as well. We actually saw a pretty big uptick these last 2 quarters in 120 plus days late. Let's take this a step further. Let's look at the student loan debt. This is dollar figures estimated from a percent of total balance of 90 plus days. And you can see this is a lot of debt, right, in student loans. And why would that be important? Is because, well, guess what? Now these student loans, they have to start being paid and because the kind of relief from it is over. And if you go back to the videos when we talked about it during here of how things can escalate and get further is when the kind of the life support of this is taken away. And just like that, boom, what do you notice? 90 plus day delinquencies by student loans, absolute monster of a move right here, meaning that we're getting more and more student loans obviously going into massive delinquencies. But if you look even closer on this, look at this blue line. That's the credit cards, right? Bam, we've been seeing a massive run in 90-day plus delinquent credit cards as well, levels that we haven't really seen since the climb of 2008, 2010, even 2011 up into that range, right? If you look at transitions into serious delinquencies by the loan type, look how big of a move it is in student loans. You can see credit cards, right? You go back, it's not to the levels that we've seen since coming out of the Great Recession. Then prior to that, obviously, we saw increase going into the recession. Also, auto loans is at a level, right, that we haven't seen since the financial crisis. Really, that's a pretty big move over there. If we continue on and you look at the age group, right, for serious delinquencies, surprisingly here, it's actually 50 plus, right? So the largest percent of balance move here from by age is actually 50 plus. And you got to start thinking, it's like 50 plus, they're transitioning into serious delinquency. Are they even going to bother paying this, right? At that point, like, so what happens at that point if they just don't bother to pay it? 18 to 29, we saw a pretty big shot up, obviously 30 to 39, and then we have 40 to 49 there too as well. Okay, let's continue on. So in short, what does this mean? It means, I guess I can conclude that we're seeing more credit cards, more accounts, higher delinquencies, and then all of a sudden now, which can add to this debt crisis taking place, or this debt burden, I should say, is now student loans having to be repaid back, and well, they're not getting paid, right? We're moving more into delinquencies, which you pair this with the changes that we talked about in the other video about the JOLTS data and how the demand for workers have kind of fallen and potential for more unemployment to rise. These things get exaggerated or I don't know what word I'm trying to look for. They can move at a quicker pace if we start to lose jobs, right? If jobs or unemployment starts to rise. Now, if we take a look at the safety ratios in the S&P 500, right? Gold relative to the S&P 500, utilities, consumer staples, TLT, healthcare, and defense, still trending lower. However, right, gold started creeping above that 50-period EMA. relative to the S&P 500. So gold is outperforming. Why are people running to gold right now? Is it extended? What's that signal? I guess we'll find out. Utilities is a new low. Consumer staples, we talked about that one already, new low. TLT is starting to creep itself back up after that big move in rates today. Healthcare, right? We're starting to put in some higher lows over here, trying to get through this. And then also defense, also trying to base out here as well. So very early stages of a potential turn into a safety trade, but too early to really tell. This is the seasonality of the S&P 500 as it typically hits these highs for the year. And then we start to move in the back half of September and further. Before the end of the year, we start to get these rallies to take place. So seasonality is telling us, hey, we might be moving into a weaker period in the near future. But it also tells us that the back half of the year could still be pretty powerful. And if you look at the VIX volatility, and this is the analog since 1990, we're moving into that period where the VIX typically sees a rise there as well. No surprise, right? S&P 500 sees seasonality to the downside. Sometimes it's very typical to see VIX trade in a way the opposite. So during seasonality of the VIX since 1990, it looks like we can potentially start to see a rise here as well. Okay, let's take a look at some of the intermarket assets. How did the market respond today? I think we still have some digestion to take place, see what the market wants to anticipate, but this was a pretty massive move in the 10-year yield and also the bond market, down 2.16% on the day. This is where things get interesting because these correlations that I've been talking about, how this is good for the market, good for gold, those correlations can break when the rate of change moves at a very, very rapid pace. You can have a falling yield and falling markets because this was pricing. It could potentially be signaling to us a growth slowdown, right? Especially when it happens at a very massive, powerful rate of change. So this is a pretty big break to the downside. We'll see here how this consolidates or how it bounces back up. If it bounces back up, right, to maybe come back up and test these areas and see what goes from there, because a lot of people are also calling for a stagflationary environment where we have rising inflation, rising unemployment. We'll see. We will see, right? We'll see what actually takes place. If you look at oil also fell, which is not really inflationary, at least for right now. But if this is coming down, we start to bounce back up and move higher, well, typically means that the yield will follow as that correlation has been rather strong, right? Oil's been falling off. The yield has been following. You can see many times throughout history where oil can be a leading indicator of where yields will go. The dollar down slightly on the day here too as well, which probably helped out gold. The falling yield probably helped out gold. Started the markets off pretty positive, but overall, once again, dollar's just in this sideways choppy range as it stands right now. You can see the correlation here currently still holds dollar down, yields down, market has been up, but there are periods of time where things collide and crash, right? We saw a massive rate of change over here in the 10-year yield. S&P 500 went with it. The dollar fell at a massive rate of change there too as well, and kind of markets went all tumbling. So there are periods where the correlations line back up to a more positive, but as it stands right now, we're still at a negative correlation as we move into a weaker season of this month or of this year. Let's go ahead and take a look at the conditions of the markets. Are we bullish? Are we bearish? What strategy works? This will help gauge position sizing. Most important part, every day you should be paying attention to this stuff if you're an active swing trader, and pay attention to it once a week, maybe more if you're even an investor, because it can help you take its throttle. Think of it a gas pedal, right? When conditions clear up, you can put your gas down when it's sunny. When all of a sudden it starts raining or there's more traffic, you got to let off a little bit of the gas. So if I take a look at net gamma, 6,500 is still the call wall. 6,600 still remains to where traders are reaching out. So bullish above 6,500, right? But below it, I'm significantly more cautious because we don't really got much going on over here. We have a nice, very liquid environment throughout here. It's pretty bullish. Down here, slippery slope, right? And if you take a look over here, we are above the gamma flip line. So when we're above the gamma flip line, you look for dealers to buy the dip, sell the rip, buy the dip, sell the rip. Volatility typically comes in. As far as this week goes, where do we start off? We started off coming down to that lower expectation of the week. The market priced it in. Market closed basically slightly up to unchanged, buck above the gamma flip line, and we're right there at that JPM collar at the upper bound. Since we've hit this, right, the market's just been doodling around in a little happy place, okay? I have the call wall up here at 6,600. Actually, if I update it, I'm going to give you the, I gave you a 6,500 call wall and 66 because it's so similar, right? They're so similar in size. So this is kind of this environment where I want to be, right? Is it up here more bullish, right? Down below it, I foot off the pedals type of environment. Going into next week, we have 65.67 for the upper weekly expected move on the S&P 500, 63.95, we'll call it 6,400 as the lower implied move, and that would put us into and around negative gamma territory if we were to get down there. If you fall into negative gamma territory, that is the environment where I typically do more day trading, or I get more signals to day trade, because that's when you really see the market and how it acts and responds differently. Dynamic hedging, right, kicks in to full gear. You get selling, beginning selling. You get buying, beginning buying. And volatility will increase when you're below that gamma flip line. And it makes for a different type of trade style, right? Above the gamma flip line, I like to swing trade, and I like to play breakouts, right? Breakouts and speculative breakouts. That's what I like to do. When we start flipping below the gamma flip line, I like to buy big dips and fade it, right? Fade for a short-term bounce, and typically use less sizing when it takes place. So it's a different type of trade. And then also, when we're below the gamma flip line, instead of swing trading from 1 to 3 months hold time, right? This becomes a lot shorter hold times under a gamma flip line, because the market tends to move a lot quicker and a lot faster. I don't know about y'all, but that right there is, if you really just rewind that and play it back, if you understand what I'm saying here and you follow this and you watch this, it's going to completely change the way that you approach a risk and trading in these markets, right? One strategy doesn't fit all markets. Just remember that. So your strategy has to adapt in certain conditions, or you got to know when your strategy works best in what conditions. And during these transitions is typically where I see the most people blow up accounts. It happens all the time. All right, another element to all of this is looking at risk parity, CTAs, vol control funds, flows, systematic flows. And CTAs, we've been pointing out that they are at an exhaustive type level, right? So if we start getting under that gamma flip line and these guys start to become sellers, remember, they don't got emotions. They don't care. They just sell into selling. They'll buy into buying. And this is what helped drove us up to these levels here from the April bottom. We talked about it down here, how they were going to become buyers. And now we're talking about it once again. We're going to continue to do it, because they're going to become sellers again, especially when we start triggering some key levels. Now, if you look at vol control positioning, same thing, right? These are all funds that are based off of volatility, basically, right? And movements and trends in the markets. Vol control funds, right? April, right? They really amplified the sell side activity going into the bottom of April. They help amplify the buy side activity, as you can see, going into where we currently are now, which we just recently hit an all-time high. So, right, if we start getting under that gamma flip line, these vol control funds can become sellers, right? They can become just more pressure, obviously, in the overall markets, and we can see more sell side in the equities. If you take a look here, this is basically taking vol control funds, CTAs, and risk parity. It's in the 83 percentile. So you get to look at like an overview of systematic flows dating back a while ago, and you can just see here we're in the 83 percentile. So it's been higher at higher levels, but as we're right here, you can see that this is where we've reached some tops in prior as well. So I thought that chart was interesting. I wish I could see some more data around it, but I don't got it. This was just from the market ear. And if I continue on, back month versus front month volatility, we are above 20%. Remember, this is typically where we get those consolidations. What have we been doing? We've been consolidating. It's also where we can see pullbacks in the market. When is it a good time to start looking for bounces and buying and being a little bit more aggressive? Well, if we start to see selling, I'd be starting to look for, right, readings below 1.0. And remember, if this type of stuff happens, right, if we start slipping under the gamma flip line, if they become sellers, if we start seeing this come off a bit, you might start to see what? You might start to see this VIX curve, right? The VIX futures curve move into a backwardation, right? Right now, this is contango. It's just telling us what? Yeah, we're here, we're cool. And yeah, and we'll look out into the history and we'll probably see higher volatility in the history later on, right? This is like me training for a marathon. I know that it's going to be harder when I'm actually running the marathon. Whereas if you're in backwardation, you're in the marathon right now. You're sweating, your legs are hurting. You need to find a station so you can, fuel up and so forth. And then that at the end of the race, things are going to calm down again. That's the best analogy that I can think of to kind of explain the VIX futures curve from a contango perspective and a backwardation perspective. I like this signal chart over here. This is looking at the put to call ratio over here. And this is also looking at skew. And the reason why I like to look at it is because you can kind of gauge sentiment from this, gauge sentiment extremes. And right out of the gate, it's not really extreme other than skew has been elevated at a rather high level, but it's been higher. It's just telling us that, hedging activity is taking place. But here is what I really want to pay attention to is if we start to see this black line go under 0.8, that black line is the 10-period moving average of the total put to call ratio. That is kind of extreme bullish sentiment signaling to me, be careful, things are getting frothy. And while that occurs, right, you want to see exactly where skew might be at that time, right? For example, at this specific area in time, actually, it's a little bit more clear right over here. Over here was a little bit different, but I'll show you both. I wish I can zoom in, but I can't. You can see over here, we were below 8.8. What was skew doing? It was rather elevated. Both of those were signs that we could see something happen. And then all of a sudden, things got very bearish. So we got above 1.0, right? And at that same time, if I just go down over here, what was skew doing? We were coming to pretty depressed levels, right? The hedges were coming off. And that was kind of the bottom of April. So if this starts coming back down over here again and we start to see skew in this area, it's just one of those warning signs once again that, hey, things can consolidate or potentially be on the signs of a bigger pullback in the very near future. Let's go ahead and take a look at the expected move. What's the market pricing in? Before I go over the expectations of the market for the SPY, which I'll do on the next slide, a lot of people have been pointing out that, hey, somebody had asked me the other day, is it pretty common to see it hit the bottom and then go to the top? And no, it's not pretty common. So I had to look back through the history and just see, has it happened this year at all? And it actually has happened one time this year. And it almost happened, obviously, this time. So this week was part pricing in about $8.60 move on the SPY. We tagged the lower implied move and we kind of just bounced from there. And we remained slightly up on the week to rather unchanged. The only time that I noticed here this year that we saw a tag from the bottom to the tag from the top was in the midst of all of this volatility. Now, that to me is kind of interesting because we haven't been going anywhere and these implied moves are rather, small. They're not pricing in, but to see these type of moves with volatility kind of contracting, I can't remember exactly where we're at as far as in terms of the VIX goes, but I know it's rather low. And then the only other time this year this happened was during all of this. I don't know. It's a little interesting. I don't know how to interpret it quite yet, but to me, this just signals that there's a lot of volatility kind of hiding from an intraday perspective, but it hasn't manifested in from like a daily perspective or a weekly perspective quite yet. So you can see here we tagged there, right? Early, this is the 15-minute chart of the SPY. We tagged it. We came up. We started putting in higher lows. Today we had our jobs data and it all moved within expectations of the market, right? We priced out what was the daily implied move, right? On yesterday's video, look where it came down to. Boom, came right down to it. We bounced from it. We came back down to it. We kind of held up, closed within the market's expectations to a T. So going into next week, what's that look like now? The new weekly implied move for the SPY is going to bring us up to around 656 and down here to about 638.50 into these zones. If you trade Monday, you're looking at a daily implied move. I believe Monday is not a holiday, right? Daily implied move of 650 to 652, 643 to 642. Now these eyeball ranges are coming from my AsherBot, but my AsherBot has not fully loaded, so I had to do a manual calculation. So these are going to be off by a little bit. If you're in the Discord, those will be able to update at 9 p.m. Pacific Standard Time tonight for going into next week, or maybe after Saturday, Sunday, you'll be able to pull those adjusted numbers and also the weekly eyeball as well. Those eyeball numbers is part of the command in the AsherBot. As it stands when I'm looking at this, 5-day moving average is flat. We're above last week. So right here is an area of confluence. If we start breaking below this, obviously that just opens the door right to these lower bounds. But as it stands right now, declining 5-day moving average to flattening. As long as we can hold above this stuff, we're still bullish. It is still bullish, but just be aware of the context of what happened here with this volatility. It showed up, right? It was well within expectations, obviously, as we just previously shown on this screen, but things are getting a little shaky. We're at some very interesting levels in terms of CTAs, vol control funds, gamma exposure levels. And then from the bigger picture view, I've already pointed out that, hey, things look like from a cycle perspective, right, could be getting bad from a macro kind of perspective. Looking at the curve could be getting bad from a kind of a bubbly perspective of back-to-back years, right? From a rate cut perspective, we discussed that. There's a lot of stuff going on, and then you break it down to the consumer. Something big could be potentially brewing. I don't know how to time it necessarily, but I do know that when the market conditions shift, I'm going to be right there ready to adjust my portfolio. Hope today's episode helps out, give you some insight. I'll see you on the next.